This is Chris Whalen, CPA, and welcome to the Street Level Business Podcast. My CPA firm specializes in business and individual income taxes. If you would rather read this podcast, there is a link to the text version below the video. If you find this podcast informative, please take a moment to like and share it. Do you have any tax or accounting questions right now? Pause the podcast and call me on 732-673-0510. Today's topic is a long-term care insurance update. Long-term care, or LTC, is a hot topic for our aging nation. The average healthy 65-year-old couple has a 75% chance of one of them needing long-term care. I have experts in my professional circles that I work with on a daily basis that can help you examine if the strategies below are a good fit. If you have any long-term care questions, call me so I can refer you to one of them. My number is 732-673-0510. I urge everyone reading or listening to investigate long-term care options. The market and products have been much improved over the limited products offered years ago. With inflation raging and nearly 10,000 baby boomers retiring daily, the price of care is constantly being driven up. For example, in New Jersey, full-time long-term care can cost upwards of $12,000 a month, and that will only continue to rise. One option is to defer some or all of that cost onto an insurance company in order to protect other assets from being depleted. Long-term care insurance can build a completely separate tax-free pool of money earmarked for care, so typical resources of income like IRAs and brokerage accounts do not need to be depleted at an additional $12,000 a month. Long-term care has been maligned in the past and has a bad reputation in some circles. The main reason for this has come from the unexpected increases to one's premiums over the years of ownership. For example, in the past, a long-term care insurance company could not raise your rates on an individual basis, but could blanket increase rates for customers on the whole. This allowed the insurance company to reassess what premiums were needed to support the future benefits a policyholder may receive. We can all see now how this turned many people against long-term care insurance. Insurance companies are quite accurate with mortality since they have years of data on when people pass away, but no detailed data for how long before death individuals will need care. This makes them typically more accurate in setting life insurance premiums compared to needing to regularly raise rates on the long-term care policies. The other historical negative factor is if one never needed the long-term care, then the premiums were lost to the insurance company. Now, it is not really a loss because no one ever wants to have to use the benefits, but at the end there is nothing to show for it. So new long-term care policy types and features have been added over the years to fix these issues. The two new types of long-term care policies are built on life insurance premium platforms. This allows a death benefit to be a component to the plan. So in case the client did not use any or all of the benefits, their heirs will receive a tax-free death benefit. This eliminates the use it or lose it aspect of traditional long-term care and helps put clients' minds at ease that someone will benefit in some way from them spending on the premiums. First, now, there are more care-centric policies, meaning these emphasize the care benefits more than death benefits. These policies are often paid for by a single premium or a 10-year level pay scenario. They are excellent for those who have cash on hand or will in the near future from selling a home or business or through inheritance. These types of policies often fit well if the goal is to protect your other assets from the burden of a care need. In my examples, I have used $50,000 of premium, but more can be invested depending on projected monthly financial needs. My advisors tell me that $100,000 is the sweet spot. For a rough example, a 60-year-old paying a single $50,000 premium can expect 4 times their money on day one, so they would have a pool of tax-free cash to draw on for their care of $200,000 immediately. That $200,000 can then either grow guaranteed with an inflation rider or be invested in the market to hopefully outperform the 3% inflation rider. There are many more nuances and customizable options to these policies, but a quick look is best for a first pass. These policies cannot assess any premium increases and would provide a death benefit of about $100,000. That death benefit is, of course, half of return of premium, with a bit of a kicker for having kept the policy in force until death. The real benefit comes when that policyholder is 85 and the accessible pool of cash they have for long-term care needs is over $400,000 after just a $50,000 original investment. To further explain, a couple who each purchased $50,000 policies would have created an $800,000 pool of accessible tax-free cash on top of any other assets they own by age 85. So if a couple has $100,000 in cash and has no intention to use it, then this is a great way to get it working to protect what they have worked so hard to save. Second, the life-centric policies are a bit simpler, but also typically more expensive. These policies are permanent life insurance products with long-term care riders, meaning they are built on a permanent life insurance platform of your choice, variable universal life or group universal life, etc., and an additional rider that allows you to access your death benefit while you are living to pay for care needs. An insurance company knows that with a permanent policy, someone is going to be paid, whether that is the beneficiaries when the insured passes or the insured themselves taking it out for care costs. The insurance company is on the hook for the face value of the policy. Let's use an example to simplify it. A 60-year-old may buy $1 million death benefit with a long-term care rider. This might cost about $15,000 premium annually until death, all depending on the insured health and underwriting, but just an example here. The insurance company is paying $1 million tax-free to someone. Either beneficiaries or the insured can start spending the policy down during life for care. Typical long-term care access runs between 2 to 4% of the death benefit per month for care. At 2%, a client could get $20,000 each month from this policy tax-free while living and paying their care providers. Each $20,000 removed does decrease the death benefit dollar for dollar. So if a client took $240,000 out, which is $20,000 per month for a year, and then passed away, $760,000 would pass tax-free to beneficiaries as the remaining amount. There is more complexity with IRS limits and rules, but this is a highly simplified example for educational purposes. To summarize, both policies discussed above have death benefits and care benefits at a level premium price. They each answer the two most typical pain points of traditional long-term care insurance: use it or lose it, and ever-increasing premiums. Long-term care insurance is not for everyone, but today it is a great investment for more of us than ever. Sometimes self-insuring is all that is needed, or perhaps health keeps one from being insurable. Either with or without insurance, there needs to be a plan in place for exactly how to spend down from a specified source of assets if a care need arises. Without that, you are simply hoping to be in the 25% of those who will not need care, which of course is not much of a plan at all. This brings us to the end of this edition of the Street Level Business Podcast. Questions, concerns, call me on 732-673-0510. Thanks for listening. I hope you found this podcast informative. If you want to become a subscriber to my podcasts and memos, please send an email to chriswhalencpa@gmail.com and I will add you. Remember, the moment you have a business or tax question is the moment you should be calling me. Have a great day.